Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Wednesday, January 18th, 2023. It's now the 17th. We start off in the S&P 500 daily chart in DeMark, looking back to end of December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential sell setup 7 count. And to negate that for end of day on the 18th, there must be a close below 3969.61 for the price flip to the buy setup count 1. The relative retracement up 1 could become qualified tomorrow with a close above the level 3998.51 for relative retracement is qualified up 1. And the trend factors moved up a little to the top of this bar, high of 4015.39. And the first one, down one, is at 3891.05. You can see the rest here. Price in the aftermarket hours for the S&P 500 on the 17th at 8:36 p.m. is 39.83. And close to print the bar 8 sell setup count 8. It's got to stay above 3969.61, and that's great and everything, but I'm really looking for the 9th bar end count sell setup, and that's at 3983.17. So if tomorrow can manage to stay above this level's close, then the next day we need to stay above 3983.17. And so for me, we must stay above that level, and price in the aftermarket hours is 39.83. So the S&P 500 hasn't really moved up like I would have liked it to, so it's going to be pins and needles to print the sell setup 8 count and then the 9 count. And if it blows any one of those for 8 setup count and 9 setup count, then that takes the wind out of the sails of this uptrend here, and I'll be thinking about selling. But we'll still have to give the S&P 500 price the benefit of the doubt until it gets under the Ichimoku baseline 3932.73. The S&P 500 weekly chart in DeMark, looking back to COVID crash 2020. I'll zoom into the current area now. And the S&P 500 weekly chart has printed the combo and sequential aggressive sell setup 2 count, and to negate that for end of week at end of day Friday, there must be a close below 3844.82 for the price flip to the buy setup count 1, and that would put it below this ongoing demand line and probably qualify that. And then there's a ongoing supply line at 4034.98. So it's almost like a symmetrical triangle pattern here that the S&P has gotten itself into, and we're right at the apex here. And DeMark lines are for the daily chart, but we use them in the weekly chart. We just don't pay that much attention to qualifying and confirming them. We basically just use them as lines. And the weekly high channel 3 has fallen below price, so it really took a dip down from last week. So in between the ongoing supply line and ongoing demand line, There's the channel 3 high, the conversion line, and then the baseline, along with the 39-week moving average Bollinger Band midband at 3936.65. So there's a lot there for support. And it looks like this is still the level to watch for this conversion line, 3932.73, as it is equal to the daily baseline. The NASDAQ Composite New Highs, New Lows weekly chart as of the week of January 9th, so it runs about a week behind. And it has started to hook around to the upside quite distinctly this time. There was other times where it looked like it was going to and then just fell off the face of the earth, but this is the most distinct hook around that I've seen during this whole downdraft period from the beginning of 2022, end of 2021. And the conservative way to play this is to wait for the new highs, new low line in black here to meet the falling signal line here in red. And you can see where they're highlighted here with these red ovals where the new high, new low line crossed above the signal line, 39-week signal line. And we can take a look at the COMPQ, which is the NASDAQ Composite. We'll go over there and look at that. And here's a spreadsheet of the weightings of the COMPQ. And you can see they're all in there. Apple and everything in the NASDAQ 100 is in the COMPQ. And I just downloaded this on the 17th today. And in the COMPQ, there's 3,657 instruments inside of it, international and domestic instruments for the NASDAQ Composite. And we all know the NASDAQ 100 has 100 stocks in it of the large cap, and they're all within the COMPQ NASDAQ Composite. And here's the COMPQ to QQQ relative performance ratio. And I have an Andrews Pitchfork here, anchored right here and here. That's a nice anchor there for the top and bottom tines of the Pitchfork. And you can see how this line here that connects the top and the bottom and middle runs right along the downdraft here. And I have it anchored up here in February and March of 2021. And you can see how the middle tine just about goes right through the middle of this line here. So that's in a nice position and well drawn. So this COMPQ to QQQ relative performance ratio is very similar to the NYA to SPX relative performance ratio, in the fact that all of these instruments in the Qs, QQQ, are in the COMPQ, just like the SPX instruments. 500 stocks inside the SPX are within the NYA. And you can see since the end of December 2022 that it was everything except the NASDAQ 100 that was going up. So technically this just cancels all of the instruments within the Qs are canceled within the COMPQ. So we're comparing everything else in the COMPQ other than the Qs to the Qs. And right there you can see it's a value play here. So, I mean, there's a lot of value within the NASDAQ composite. Although it's heavily weighted towards technology, there are a lot of value technology stocks within the COMPQ. So the COMPQ QQQ relative performance ratio is at the top 10 of the Andrews Pitchfork. So what we're looking through is a breakthrough to the upside for all the left behinds in the COMPQ. So in other words, everything except the big fangs. And back in the new highs, new lows for the NASDAQ composite, you can see these areas here in 2016 and after the COVID crash where the fangs had their day in the sun and were just trouncing everything else in the NASDAQ composite. That's where you would look at the NASDAQ composite and just think of the NASDAQ 100 because they were just dominating everything within that big index. And that might not be the case this time if this can hook around and meet its signal line and get above it so we can put another red oval on there. It could be everything else except the big fangs and everything in the NASDAQ 100. Unless this turns around from hitting the top of the Andrews Pitchfork and starts heading down like this here, but that would definitely increase the valuations of those stocks again. And what the Fed is trying to do is decrease the valuations of all those stocks in the FANGs and NASDAQ 100 that are in the astronomical realm of existence. Yes, the big companies like Apple, Microsoft, probably even Tesla now, etc., do deserve higher valuations than most all of the rest of the instruments inside the NASDAQ composite, but they're still so overvalued that it has to come down more. And if that's the case, and the Fed really does stick to his guns and brings it up to 5 or 5.5% Fed funds rate and holds it there for a year, this should break out to the upside, and all the other left behinds in the NASDAQ composite will be the ones to pick. So the big question is, will the left behinds be able to get above this red signal line here in the new highs and new lows weekly chart? And this is where that saying, it's a stock picker's market, really comes into play. Everybody's been saying that, all the talking head analysts in the media, and it's really true, because if you pick the right ones that are going to take us above this red line here, then you'll be on the new regime shift and riding that wave up. But really the question is, can it really happen without the fangs? So again, the conservative way to play this, if you're not a stock picker, and is to wait to see as it approaches this signal line, this black line gets near the signal line, to see who the market leaders are at that time within the NASDAQ composite, so you can pick the left behind technology stocks that have been beaten down by the fangs and left behind for years. The S&P 500 support and resistance levels big board chart shows the gray areas at the pivot point, the 200 exponential moving average, daily Bollinger Band, upper band, and the downtrend line from 01/04 2020. And price in the aftermarket hours for the S&P 500 on the 17th at 8:57 p.m. is 39.96. And so to the upside is the relative retrace up 1, R1, and the conversion line 26 bars back concerning the lagging line, and the close above the relative retrace up 1 at 3998.51 will qualify this level. And to the downside is the 200 simple moving average, S1 and S2. And the weekly high channel 3 has moved down from the 4,000 area down to 3,900. The NASDAQ 100 daily AD line is still above its 21 EMA signal line, but not by much. S&P 500 AD line is faring a little better, and it's narrowing though with its 21 EMA signal line. And the PPO extreme is at 0, so I haven't seen that for a while, if ever. And the sideways action for the ROC 1 and the ATR2 from Friday, see that video, and that resulted in a downside move, but I kind of expected that anyway. And the New York traditional McClellan breath oscillator to get back to 0 would require 4,361 decliners over advancers to get back to 0. So that's still a long way to 0. And 3983.17 is the level to watch. And that's right here on January 12th's close. So that will be the close that price needs to stay above in a couple of days to print the sell setup 9 end count. And if it does that, it will be sending out a loud statement of upside, as we'll get the new TDST level moved from 3583.07 to the true low over here on the 5th, 3802.42. Have a great day.